Hey everyone, welcome back to Corporate Decoder, the place where we dissect corporate filings. Today we are looking at a filing that involves related parties' promissory notes and purchase price adjustments. It's a bit like a financial jigsaw puzzle and we're here to put the pieces together for you. Today we're diving into an 8K filing from Awaysis Capital. This is a current report, meaning it's filed when something important happens that investors should know about quickly. The event that triggered this report happened in April of 2025. This filing is about an amendment to a previous agreement. Last year in December, Awaysis Belize, which is a part of Awaysis Capital's agreement. Here's a twist: Chiol Mountain is connected to Michael Singh, who is the chairman and co-CEO of Awaysis Capital. So the company is buying something from its own chairman. The original deal was estimated to be worth 5,500,000 baht. That amount could change depending on a few things. The payment was planned $100,000 promissory note, which is basically an IOU, and another note for 1,000 SOE note, which is basically an IOU, and another note for $1,600,000 that could be converted into stock. The first IOU, the promissory note, was supposed to be paid by February, or when the company's stock got listed on the NYC American, a stock exchange. Now, in April, Awaysis Capital and Chiol Mountain changed some of the terms in their agreement. They extended the due date of the 15 a bit slower on this deal, $100,000 AOU to July or whenever the company's stock gets listed on the NYSE American. They also pushed back the date for figuring out the final purchase price based on an appraisal to 12/20. This section simply refers back to the previous information about the changes to the promissory note. It's important because it highlights that this change creates a direct financial obligation for the company. This exhibit is the actual document that spells out the changes we just discussed. It's the official record of the agreement between Awaysis Capital and Chiol Mountain to modify the terms of their original deal. Now let's step back and look at the bigger picture. This whole situation involves some potential risks and opportunities. On the one hand, buying assets from a company affiliated with your own CEO can raise eyebrows. It's what is called a related party transaction. People might worry about whether the company is really getting a fair deal, or if the CEO is benefiting personally at the expense of the company and its shareholders. This is why such deals need to be carefully reviewed and approved by independent members of the board. On the other hand, if the assets Awaysis Capital is buying from Chiol Mountain are valuable and help the company grow, it could be a good move. The extension of the payment deadline gives the company more time to come up with the money, and delaying the final price adjustment gives them more time to assess the true value of what they're buying. However, the fact that they keep extending deadlines and adjusting the purchase price suggests that maybe they didn't fully think through the deal in the first place. This could be a sign of poor planning, or even worse, a sign that the company is struggling to manage its finances. Ultimately, whether this deal is good or bad for Awaysis Capital will depend on how well they manage the assets they're buying and whether they can successfully integrate them into their business. Investors will want to keep a close eye on this situation to see how it plays out. Thanks for watching. If you found this breakdown helpful, please like, comment and subscribe for more Corporate Decoder episodes.